Investors post the strong first half move in the overall markets into mid-July. The overall markets have been trading sideways to down, just as our investment team laid out in our late June podcast titled S&P 4300 Plus, It's Summertime for a Break. We followed it up almost weekly with additional content on how historically normal 2023 has been so far. What, when, and why our investment team expected weakness in the third quarter markets, risk to the fourth quarter, and when and at what level we expected the markets to finally regain their footing and upward trajectory. The title of this week's episode is Get Ready for Fall. Before we press onward, please take a moment to click on both the subscribe and notification bells so you will be alerted when our investment team uploads our latest content. Or better yet, give our Oak Harvest team a call at 877-896-0040 to speak to our team and set up an initial consultation with an Oak Harvest advisor to discuss your financial situation. So investors, the S&P 500 has gone net nowhere in a sloppy, choppy manner since Wednesday, June 12th. As of this writing, the S&P 500 has been flat for almost 3.5 months. As the Oak Harvest investment team warned clients and prospects in early summer, we were set to enter a sloppy, choppy time frame. Call it a trading range, call it a general consolidation, call it a lull, but history and the data said we were set to frustrate many latecomers to the 9-month rally off the October 2022 lows. I must remind investors, this was the day after semi-retired hedge fund billionaire Ray Dalio, having missed almost 20% plus off the October 22 lows, said it was time to buy stocks. Here's the daily chart of the S&P 500 for the last 18 months. The short-term good news, as of this writing, the S&P 500 was already down over 300 points and over 6.25% in just under 2 months. The markets are now getting oversold in terms of price, and sentiment is quickly turning dour compared to its mid-July enthusiastic levels. Here's a chart of the cash S&P 500 with a MACD indicator at the bottom. MACD is short for moving average, convergence, and divergence, and is a common momentum and oscillator indicator many traders use. At 42.75, we are quickly approaching what our team thought would be support for the markets during late summer and early fall. 42.30 to 42.85 on the cash S&P 500. This is at the same time we'll be exiting what has historically been the worst 10-day to 2-week trading period of the year. That's the second half of September, post-option expiration into month end. For all those data nerds who follow this stuff, here's the pure daily return data from Steve Suttmeyer at Merrill Lynch. What I find interesting is, one, that Suttmeyer's data is quite in line with another market historian our team follows, Larry Williams. Yes, the same Larry Williams who occasionally is referenced on Jim Cramer's Mad Money show, and the same Larry Williams who is one of only a few strategists, traders, and investors I know who correctly forecast the timing of the COVID bottom, as well as the upside strength afterward. So investors, the good news is what we've experienced the last 2 to 3 months is seasonally very normal and should be nearing an end. The bad news? I said nearing an end, not over and done with. Even if we are nearing an end on the price declines, which we expected to be in the 42.30 to 42.85, we still have likely more time on the calendar to go before investors exhale and return to quite a normal year-end rally. For what it's worth, zooming out on Suttmeyer's work, one zeroes in on October 19th, being historically the last of the poor trading days looking back in time. Remember though, past performance is not a guarantee of the future, and nothing in the stock markets is ever both perfectly accurate and precise. But I don't want to leave you on a down note, so I want to leave you with this. Year to date, it's been a normal third-year election cycle as one could get versus historical norms. Should this continue to play out post-October expiration, one would be looking back up towards 4,600 into Thanksgiving and back approaching all-time highs into year-end. Call it 4,750 to 4,800. And more new all-time highs, albeit with much higher volatility in the first quarter of 2024. If you want to track one real-time piece of data, keep watching real interest rates. Yes, don't watch inflation rates, but real interest rates. Why? Because inflation and inflation expectations are rapidly dropping, but the stock markets are being held back by hawkish talk of Federal Reserve members, which are keeping real interest rates, which determines the equity risk premium, or ERP, and goes into calculating a fair value, or fair PE, for the overall market. Investors, lower real interest rates translates to higher equity valuations and higher PEs, all else being equal, where the all else is usually earnings. Oak Harbor's first half outlook for 2023, which played out as we expected, was based on a realized peak in October of 2022 in real interest rates, peak in volatility, and the historic norms for a presidential election cycle. So far, the summer is also playing out as expected and playing out to the tune of normal. It's interesting to note that the strongest year-end stock returns for the markets have come not when the markets are up most through summer, no, not when they're up over 20%, but rather when they're up between 10 and 20% for the first 8 months of the year, like we were this year. The most recent positive 20% or more run in the markets was in 2021. And while 2021 closed strongly and at all-time highs, we know how the first half of 2022 played out. At Oak Harvest, we currently manage broadly diversified equity portfolios that balance risk and reward for our clients. We don't concentrate our client funds in only one or two sectors seeking to hit a grand slam. We try to hit singles, doubles, and occasionally a homer if someone makes a mistake and we find a stock at the right price at the right time. Our advisors and financial planners usually use a combination of market-based and insurance-based tools to meet your retirement goals. Investors, our investment team is busy working on some new and highly unique equity models and tools that few RIA advisor teams have access to and few investment teams have the experience ours does. One of these tools may even allow our investment team to express negative views on single stocks, sectors, or the overall markets if we so desire. Stay tuned. The future in the stock markets are always uncertain, and that's why our retirement planning teams plan for your retirement needs first and your greed second. Give us a call to speak to an advisor and let us help you craft a financial plan that helps you meet your retirement goals. Call us here at 877-896-0040 and schedule an advisor consultation. We're here to help you on your financial journey into and through your retirement years. From the whole team here at Oak Harvest, almost 40 and growing, have a blessed weekend.